Good morning, everyone. You are watching a live daily market outlook for Friday, 8th of March 2013, prepared by Windsor Brokers. Big day today as the main focus is on the U.S. non-farm payrolls data that were moved from the last Monday. That was initially the first last Friday. I do apologize. It was the first Friday of the week, but it's moved for today. And most of investors are now awaiting a release that is due at 13:30 GMT. During the night, Chinese export data showed that the exports soared above the forecast and jumped by a fifth in February from a year ago, a sign that the country's modest economic revival is intact and suggesting a global demand that might also be on demand. Underlying expectations that China's recovery is fragile and vulnerable to a wobbly world economy. Chinese imports were surprisingly weak, falling 15.2% from a year earlier to 13 months low. Some analysis suggests that exporters might have overstated their businesses to sneak funds into the country and avoid the capital restrictions, an argument backed up by figures showing rising money inflows into China and weak trade reports elsewhere. From yesterday's business that we have to highlight comments after European Central Bank left its rates unchanged. Basically, the comments of President Mario Draghi dragged the euro higher when he put forth a relatively upbeat view of the Eurozone economy, pressing the point that the worst may be over for the region and that the process of recovery will start to kick in as this year progresses. Some comments earlier from Mr. Draghi were quite similar. As he said, the second part of 2013 and the first part of 2014, we can expect some more significant results in the recovery of the Eurozone economy. Although Mr. Draghi acknowledged that the most recent hard data in Eurozone continued still to point to contractionary conditions, he also noted that the latest sentiment surveys have seen an uptick in optimism and stressed that these reports were more reflective of true conditions on the ground. According to his comment, the contraction in the Eurozone economic activity is a function of the overhang from fourth quarter of last year, and that demand should slowly pick up over next few quarters. This is from comments of yesterday that basically pulled the single currency up from the dangerous 130 zone as the price reached 131 handles so far, where the gains were capped. Again, the question between analysts and the trader, among the analysts and traders, is still is this going to be a sustained recovery, or is just another corrective action? Whether the euro is going to start picking up pace or will just continue its broader weakness that started from a peak of 137.10. From the other currencies, dollar remained strong against the Japanese yen and hit 3.5-year high against Japanese currency, with of course, the near-term focus still on the U.S. data and the jobs data that will, whether the jobs data will fuel hopes for further recovery in the U.S. recovery market. As said, we are looking for this release as the top release for today. Meantime, we have the economic indicators that are preceding the current release. Switzerland CPI data that are due in a couple of minutes for February, showing no change. Inflation is said to stay at lower by 0.3% in month of February. German industrial production for January is expected to pick up according to the current forecasts by 0.6%. And then this is basically the most interesting from Europe. Then data from Americas. Of course, the top release is non-farm payrolls that are forecasted to at 161,000 new jobs compared to 157,000 of the previous month release. And of course the unemployment rate in February, that is according to the forecast expected to stay unchanged at 7.9%. Also from Canada we have unemployment rate that is expected to tick higher to 7.1% according to the forecast, with the employment change in February expected to show 7,800 new employments compared to the contraction and the growth of 21,900 seen in the month of January. And basically these are the most important releases for today. Of course, the main focus remains on the U.S. non-farm payrolls data, and most likely after the release of these figures we will have some a more clear picture of the current market situation for the most of instruments. Starting with a technical outlook with the euro, as always. We will see that on the hourly chart. I think you can see it now, that single currency jumped and emerged out of the dangerous territory after hitting fresh low yesterday at 129, 2 days ago at 129.49. Quick recovery that was fueled and accelerated by Mr. Draghi's comments, reached exactly 131.89, just ahead of round figure. I think we have mistake, reached 131.08 ahead of more. I do apologize, it's just a problem with the chart. If you give me a second. There is a small jam in the charting system and I cannot open it now. Apologies for this. Okay, we have it now again. The pair reached 131.16, just above 76.4% of the downleg from 131.61 to 129.49. Breaking above relevant moving averages sees potential now for further extension higher, as 4-hour indicators now in the positive territory see more room towards the upside. Now the question is how sustainable is going to be this break. We have another important barrier, which is 131.61. This is high of 28th of February. Close to it is the channel resistance currently at 131.42, and basically break above these levels is going to be the first signal of a basing attempt at the recent lows at 129.65, 129.49 for possibly building up the double bottom pattern in case, of course, of a break above these levels. As said, the 4-hour structure is still holding a positive tone and sees upside more favored at this point, while hourly indicators now are descending. This is the corrective movement on the overbought near-term conditions, and still sees more potential towards the upside as long as we are holding above previous highs that are approximately at 130.70 zone, reinforced by ascending 55 days exponential moving average currently at 130.55. Immediate action is seen now as the 10 days moving average crosses 10 days moving average crosses below 20 days one. This is initial pressure seen at this point, but so far the still positive tone sees again more potential to the upside. Of course, a lot will depend on the fundamentals. We are just finding a support at 23.6 of the yesterday's recovery rally, and ideally reversal somewhere around this zone. This is approximately close to the previous highs, will be seen as ideal point for reversal, and again break above 131.60 break point is seen as initial signal for some stronger recovery. From the other side, daily structure is still showing a negative tone, and while holding below initial 131.60 zone, again it will be the similar situation. Big white candle seen yesterday is seen as now as initial recovery signal that requires confirmation on the weekly close above a minimum 131.60, 132 in order to confirm the near-term recovery, though the indicators now started being in the neutral, negative territory, started to point higher, while RSI still holds sideways movements. Possibility of stronger recovery is still seen likely according to the lower time frames studies. From the other side, British pound lost ground again after unsuccessful recovery attempt from previous lows at 149.63.66, stalled at 150.80 yesterday. This marks exactly 50% of the latest down leg from 151.97 to 149.63, and subsequent dip again below 150.00, 149.81 seen so far sees the downside still very vulnerable. Negative tone that still prevails in the hourly charts doesn't see much of the positive action for the pair so far, unless we see the break of yesterday's above yesterday's high at 150.80. 4-hour structure is even more negative, as all indicators are firmly negative and all pointing lower, with the descending 20 days moving average currently at 150.43, maintaining the negative structure and limiting the upside at limited yesterday's rally at 150.80, while a larger picture is limited by descending 55 days exponential moving average currently at 151.23. We need to see the break above initial 150.80, 151.00 in order to signal some recovery and avert immediate downside risk. Otherwise, quite likely scenario could be a breakdown towards 149 that is seen as initial target, as basically the pair remains in the strong downtrend of 163.80, with downside acceleration seen on a break below 156 initially, and then 150 to 30.60 zone. That was the previous range floor. Now acceleration lower again, sees more focus towards the downside, and the most likely scenario would be extension down towards 149.00 and then 148.53, which is 61.8% retracement of the multi-year price movement from 2009 low at 135 to 2009 high at 170.41. To improve the structure and the larger picture, we need to see a gain of minimum 152.30, 152.60. Otherwise, again, saying risk is firmly to the downside, as even the near-term structure is currently negative, and the improvement on today's trading requires either break above minimum 150.80, 151 that marks 50 and 61.8% retracement respectively, while regain of levels at top of the recent congestion at approximately 152.20 would be confirmation of near-term base and possible stronger recovery. Until then, the current congestion is still skewed towards the downside, as the pair continues to post marginally fresh lows. That sees again more focus towards the downside. From the other side, the top performer is still dollar yen, as yesterday's rally and the early morning's attempts higher posted again a fresh high at 95.43 versus yesterday's one at 95.08, after break above the recent congestion that was limited at 94.55, and the subsequent strong dip that initially seen increased risk of deeper reversal of the larger uptrend after the pair lost 92.00 base. Near-term support was found at 90.85, and since then strong ascending is seen, a clearance of 94.55 and 95.00. That was our initial upside target high of 2010, and now sees potential for a further extension higher as the pair is continuing to advance. We have a 96 95.72, which is the low of March 2008, and then 96.00 is round figure psychological resistance seen as next upside the targets. Overextended conditions on the hourly chart suggest that some corrective action is likely in the near term, as well as 4-hour indicators now entering overbought territory, yet no any signal of reversal, as all indicators are still pointing higher, opening way for possible extension towards our initial targets that are not far, 95.72 and 96.00. Daily indicators are starting again to point higher. This is referring to MACD that was in descending mode following a current correction, while strong momentum is being built on the daily chart, showing that upside is still favored in the near-term trading. Swiss franc is still at the back foot after hitting a fresh high at 94.86, short of 95.11 initial targets, with dips so far being contained at 94 zone that marks 38.2% retracement of the up leg from 92.78 to 94.87. Recovery attempt so far being limited at 94.50. That was our initial resistance, ahead of another one significant at 94.61, previous peak of 1st of March. And the fresh acceleration lower sees risk of deeper corrective action that will be confirmed and triggered on a break below yesterday's low at 94.08 and basically 94 zone that marks 38.2% Fibonacci retracement, below which we'll be looking for 93.90, which is a previous range floor, and 93.83, 50% retracement. Basically between 94 and 93.80 we have quite a strong support zone, and break of which could affect the larger picture bulls that are still unobstructed as the pair continues to advance from recent low posted at 90.20 on 1st of February 2013. And basically the break below 93.80 and will be confirmation that the pair is entering the corrective phase. So far, low support at above 94 handle sees still upside favored, though descending indicators on the 4-hour chart are again seeing increased risk towards the downside. From the energies, from the commodities, crude oil has regained the ground after finding support at 89.35.55 zone. This is seen as attempt of building a base at these levels, as bounce higher so far reached 91.70. We have the obstacle now at this zone, which is 55 days exponential moving average, and basically break here is required, seen as required for confirmation of the double formation of double bottom and possible further advance. Again, is seen as a corrective part of the larger downtrend from 98.63 down to 89.35 low reached so far. And on the daily chart, this marks over 61.8% of entire rally from 85.20 to 98.63. Daily indicators are starting to point higher. That gives initial positive signal, especially that the price broke above 90 days moving average, and now we'll be looking for a test of the upper barriers that are at 92.00 previous lows, and levels at 92.89 we have 38.2% retracement, and 93.40 previous lows. I would say at this point a stronger recovery above 94.00 will shift the focus higher and look for a further advance. Otherwise, anything below this could be just seen as a corrective action and preceding a fresh weakness, as the bearish break of 20 over 200 days pardon, 20 over 55 days moving averages puts additional pressure on the near-term structure, and currently this could be seen as a corrective action of the larger down move, as the pair so far retraced over 61.8%, giving quite clear signals for some further weakness. Again, a lot depends on the fundamentals, and of course today's release of non-farm payrolls data, but another significant point is that 200 days moving average on the daily chart so far holds the downside, and there was still no clear break below this support that could indicate some stronger recovery ahead. A lot of work ahead of us, ahead of this, as we said, 92, 90, 93, 00 seen as the next significant target. Of course, after breaking the current congestion tops, which are around 91.70, while regain of 94.00 will be confirmation that we are in the corrective mode, in the positive, establishing a new trend, basically, with the base at 89.35 recent lows. On the other side, the extension lower and break below 89.35, seen as an alternative scenario, will be looking for test of 88.37, 76.4% Fibonacci retracement, and the recent lows of 21st of December 2012 at 87.95. So we are looking for 88.40, 88.00 zone as the next downside target in case of break below 89.35. While current structure on the near term is still positive and still aiming towards the upside. And finally, the yellow metal that is still entrenched within the certain range that is limited on the upside at 1587, and on the downside is approximately 1565 area. Sideways movements and neutral tone on the hourly chart. Again, rather neutral is also the 4-hour structure, as descending 55 days moving average so far, capping the upside, and seeing not much potential for the stronger recovery. Break above initial resistance at 1587, that so far the pair is the price is lacking momentum for, will be seen as initial trigger for a more significant 1600 level, that is psychological resistance, and 38.2% of a larger 1684, 1554 descent, while break above previous high of 26th of February at 1620, that also marks 50% retracement, will be the stronger signal that gold is emerging out of the dangerous territory and looking for a stronger recovery of the larger down move, that the latest down leg and the strong acceleration seen from 1684. This is the high of 7th of February 2012. On the other side, as more pressure is still seen towards the downside, loss of initial range support at approximately 1564-65 zone, which are the recent lows here, would attract immediately our key near-term support and low of 21st of February at 1554. That will bring more risk towards the downside, and the critical support that we are not far from 1520 area. This is multi-year range floor, break of which is seen as a trigger for some more significant corrective action of over 10 years uptrend of yellow metal that start from approximately levels below $300 per ounce and ended at $1,920 per ounce, record high of yellow metal posted in September 2011. And the larger picture, as we can see, that there is still no significant corrective action, rather consolidation under 1920 high. Hesitation as the pair approached, the price approached psychological and strong 2000 barrier. That was quite common within the traders, seen as the next target. So far, the 2 years, nearly 2 years, 1.5 year congestion here in the consolidation sees that basically the gold is still not ready for this, but however, from the other side, holding above this critical support still keeps the upside targets in focus. First strong barrier is at approximately 1800, and then we have 1920, and of course 2000 as next target in the medium term, I would say. From the other side, the break of 1520 critical support is to trigger a stronger corrective action, and we'll be looking for next levels, next significant level, that is approximately $1,300 per ounce. And this is all from my side. Do we have any questions, or we are going to wait for the release of NFP data and then comment the things, how are they going to be? I think, yes, we are going to wait for NFP data and then ask the questions. In any case, since no questions for today's session, we're going to conclude it, and I wish you a nice Friday as the last day of the week. Of course, a nice and relaxing weekend that will make us ready for the next week's action. Of course, a lot of action still expected to be seen today after a release of non-farm payrolls from United States, with most of the markets most likely seen in the sit and wait mode until the release comes. Just keep an eye what is going to be the release. A more positive think according to the forecast or above will be quite a good signal for the further recovery of the U.S. economy. In any case, I wish you a nice Friday again, and good and profitable trading. Good luck.